Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, February 17th, and this is a weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I am not a registered financial advisor. I cannot give you personal and individualized financial advice. This is for information purposes only. Please do your own due diligence. It's your money. It's your responsibility. Okay, let's get into the data. So we've shown this chart before. Here's an updated chart. Obviously, you can see that defaults on loans and high yield bonds are creeping up. This is what we expected. You can see this line here, dotted line. This is when the Fed started raising rates, and you see that we're definitely in a default cycle. You've seen what has happened in prior recessions. The recessions are highlighted in gray, and that's what you typically see, right? The business slows down. The cash flows available to service the debt are not available, and weak companies default on their debt. Now, this hasn't really made major news yet, but I think if rates stay high, you will see that. We have this continued view that I believe that the last 100 years of economic history is in effect. I believe that the business cycle has not been abrogated. If you want to spend a lot of money like the federal government does, you can, for some period of time, keep the economy from falling apart. But we definitely, the underlying data, in my view, is not where it needs to be. Okay, and you can look at various areas of the economy. Like I said, you can say battle of the statistics, but I still just don't see that the current business cycles have not been, like I said, abrogated. So this is a symptom. We'll see if it becomes an issue. Maybe it won't be an issue, but this is not positive. At some point, this becomes a problem, especially if you have debt that you incurred at a time period when rates were quite a bit lower, and now that rates are substantially higher and you have to roll that debt. How does that happen, right? So there's a lot of companies out there that won't be able to do that, and I think that's being reflected in what you're seeing here on the right. We've shown this chart before also. Bankruptcies are on the rise. Again, here's where the Fed started raising rates. Chapter 11 commercial bankruptcy filings are increasing. That's not positive. Again, it comes back to, I think, debt and the ability to service your debt. If your balance sheet is not good, and then you can't roll the debt, you can't get any more, you can't go to the bank, and if they will give you a loan, the terms are onerous, then this is a situation a lot of companies end up in. So people will point at GDP growth and things like that. I don't necessarily want to get into these conspiracies of accusing the BLS or government agencies of, faking data and stuff. I just think that what normally happens, people ignore, which is you get an initial set of data and then it gets revised several months later after more data comes in. The revisions come and things get revised lower. So again, you could sit here, somebody that's really bullish can say, well, what about this? What about that? Then I can say, well, what about this? For example, the manufacturing PMI has turned upwards, but is that a reflection of the economy entering a new growth cycle, or is that inventory restocking? So it just depends on really kind of paying attention to what's going on. I mean, when you go out there and you say, okay, everything looks good, but what are the people feeling? Why is there so much discontent? Why, if you're in the upper income brackets, yes, I mean, you're doing well, you're going to do well. If you have a lot of savings with T-bills at 5% or above, you got, a lot of money coming in. If you're in various areas of the stock market, you're doing well. But the underlying data for a lot of people is not good. and especially around, price increases. We saw this week producer prices come in and they weren't positive, right? They weren't declining, and so that's giving people pause around what about these rate cuts. And so originally people were talking several months ago about 6 rate cuts this year. Now with the inflation rate where it is, or the recent inflation data, what's the Federal Reserve going to do? So again, has the bazooka been put back into the on the shelf? Okay, so that's particularly concerning when you have the stock market at the levels that it's at. In my view, at least in the U.S., very overvalued. Here's Game of Trades. I really like this Twitter feed. I follow it. Lots of good stuff. 60% of U.S. metropolitan areas have rising unemployment. So again, these are periods of where you had recessions. This was the tech wreck. This was the great financial. No, I don't know what they did here. They got this kind of jacked up. Anyways, this should be 2010. But anyways, this is the great financial crisis, and then the whole COVID pandemic, and now you're climbing to areas where in the past we've had recessions. So again, take the information, and again, we're not forecasting here. We're just showing you nowcasting because we're trying to determine, especially if we're bullish on gold like I am and commodities, with more and more central banks around the world beginning to cut rates, liquidity is increasing, but we need to see the ECB in the US, right, start cutting rates to really supercharge what I think is going to happen. So I think it's inevitable, but we'll see. We just we just take our positions. I take my positions based on what I think is going to happen. I try to focus on things that are undervalued, and then look at this and say, okay, well, when's the right time to really press the accelerator? Just because I have a position in certain companies doesn't mean that I have a full position. A lot of times I take a starter position as I have a view on something being undervalued, and as it begins to mature or grow into the thesis that I had for it, I will press the accelerator. I'll press the bet. So that's why I'm so focused on looking at a lot of this information, because unfortunately, Peter Lynch did say that in the over many years, how a business performs is how the stock will perform. But again, that's absolutely true, which you can see from any of these growth stocks that have over 5, 10, 20-year periods, how they compound wealth. But in the short and medium term, as I've said before, liquidity and sentiment is what drives stock prices. So this is the really big thing here to keep in mind. This is the excess savings that people had, and as it runs out, what will the consumer do? We've seen delinquencies on credit cards increasing. We've seen delinquencies on auto loans increasing, and I think it's just a manifestation of excess savings right now. People have a certain expectation, as I've said before, for a certain lifestyle that they want to live, and they were enabled to do that. And then if they're no longer able to do that because their wages don't keep up with inflation, or they're laid off or whatever, they have a tendency to go into debt. I mean, people don't really like to cut back in many cases. Most of the middle class and working class have a high propensity to spend. So when they get money, they spend it. And if you bought a house with a certain mortgage, if you went out and bought a new vehicle, you have commitments for payments, and then you want to eat out a certain amount, all these things. So you created this lifestyle for yourself, and then you well, I don't want to have to cut back. And so the excess savings from the government injecting all this money, free money, into the economy has slowly but surely been bleeding off. So the question is does 100 years of economic history and business cycles come into play once this excess savings runs out? or are we in a new era where central banks and governments have been able to, abrogate the business cycle? I guess we're going to find out in the next couple months. So this is from Jeremy Grantham at GMO. Just a note here. It says bullishness is off the charts. The S&P 500 is the most overextended it's been in 50 years, and consensus bulls now match the highest level in 20 years. Allow me to reiterate today's intro quote by Jeremy Grantham. This is from another writer, Blumenthal, that I follow. He was quoting Jeremy Grantham, but the quote is, quote, sustainable bull markets don't start with Shiller PEs of 33 and full employment, unquote. And so again, that's what I say. I mean, we're in a bubble blow off of a small number of stocks that are being pushed higher. And I don't believe personally that the economic fundamentals are going to, move this market higher. I think, again, what I've said is we're going to have to see, with these PPI numbers that came out, and inflation doesn't seem to really be getting down to the Fed's target. The Fed's going to need some kind of air cover to come in and cut rates. You had one of the central bankers out, Bullard, this week I think it was this week. I was reading an article where he said that, maybe they want to cut. I mean, he's basically saying, well, maybe we'll cut once and we won't commit to further cuts, but they need the air cover. I mean, are you really going to start cutting rates with, stock market at bubblicious levels, at valuations, as Jeremy Grantham says, that are the most overextended in 50 years? You have the highest consensus bulls in 20 years. I mean, this is not a recipe for a market moving higher. Yes, it could move higher, but is this going to be a sustainable bull market that's going to be multi-year, or are you in the middle of a blow-off top? And, on a risk-reward basis, committing capital here to some of these companies with the valuations they have is insanity, in my view, in the U.S. Now, around the world, there's other markets that are quite cheap, actually, and their central banks are lowering rates, and their economies are improving, and they are establishing themselves for the potential for, a long bull market. And so, again, I don't see why people isolate themselves just to the United States. A lot of this is just momentum. It's just chasing shiny objects. It's just uninitiated people, falling into the psychology of, not wanting to be left behind, focusing on what the news says. All of these news channels like CNBC and Bloomberg, all of the financial institutions, they have a vested interest in you psychologically buying into the FOMO and to the upward market, right? Because financial institutions want more assets under management. They get fees. These financial channels want more viewers. Why? Because they get advertising revenue for eyeballs. Same thing. So there's not a big market for what I'm selling, which is contrarianism and buying value. Now, again, if you're trading this, there's people out there that are trading this and they're killing it. Okay. And I wish them well. I'm glad for their success, but that's not what I do. I've said that before. And so I don't like being up on a trapeze high wire act. I'd rather buy something that I think is cheap and has the potential and has a narrative that I can create that shows how it's going to take something that's undervalued historically, and that it's going to market's going to recognize that and move it from being undervalued to less undervalued. I'd rather do that. And maybe that's just a facet of my age or whatever, but I think that's quite what I found is that really works. If you go back and look at all the greatest investors of all time, they don't have like years and years over and over of 100, 200, 300% returns, right? So I'm going to show a stock here coming up here that was up it's been up like 300% since the start of the year. I don't know anything about this company. I mean, all of these great investors that are billionaires, I mean, they average somewhere between, 15, 18, in some cases close to 20% a year, but compounds over many, many years. That's really how the real big wealth is created. The problem in our society is that we have a short-term thinking mindset. We have examples where people, because of the media, because they like this, because it gets the juices flowing to show the guy that traded his way to becoming a multimillionaire, or somebody that made it big buying some altcoin. That's like sexy. That gets eyeballs. That's entertaining. But that's not how lasting real wealth is created. It's just that simple. You can't show. Whereas there's these hot shots that have done it, but are you going to be that person? But see, that's what's sold. It's not sold. Well, who wants to do the hard work of identifying undervalued companies and then sit there, when you can buy stocks that are going up 200 or 300%, in the last couple of months. What's the matter with you? Don't you get AI? That's where it's at. So anyway, I would rather listen to people like Jeremy Grantham, like Howard Marks, all these people. My big guy that I like listening to is, I'm a big fan of Stan Druckenmiller. I mean, his latest 13F filing, he was buying gold stocks, right? And not junior miners. I mean, he was buying Newmont and Barrick. And if you looked at Barrick's recent earnings, I mean, and Newmont's comes out this week. I mean, why wouldn't you? I mean, you're talking about, I think in Newmont's case, a 5% dividend yield, a policy of returning cash to shareholders. Same thing with Barrick, instituted a big buyback, and not just growing for the sake of growing. Mining has been historically a business that destroys capital because the people had the mindset of just grow, 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 more. And they've a lot of these resource type companies have gotten to the mode of, especially like in the oil patch, and now we're starting to see it, like I said, in mining. Hey, let's get the mindset of maximizing the return on the assets, maximizing cash flow, getting costs down, and having a return for shareholders. That's really what this business should be about. And I think you're starting to see more of that and starting to be recognized. Now, I'm not saying, Druckenmiller in his latest 13F filing, for example, was lightening up on Apple or Amazon and Alphabet. Like I said, buying Newmont and Barrick. It wasn't like he's putting all of his money into it, but I think that was interesting that taking that position. So that's what I'm talking about, like selling overvaluation and buying things that are undervalued. Goes on here. There was another quote in this article that I'm showing you here from Sir John Templeton, which is another famous investor. Said, quote, bull markets are born on pessimism, grow on skepticism, and mature on optimism, and die of euphoria. So you can take two of these guys that are both billionaires. Well, Sir John Templeton's dead now. He died several years ago. But again, you can look at, what works. You can look at the people that were successful, and you don't see people, buying things at, these valuations that are, the highest in many years, for example. So anyway, you could take it or leave it. I think that I learned my lesson many years ago, not trying to get rich quick. I think that's a lot of the mentality. And like I said before, I think it's just encouraged by society, the media, and, the financial institutions that, want you to be in the market all the time. I mean, if you ask a realtor, is it the right time to buy a house? Of course, they're going to say it's always time to buy a house because they're incentivized to get a commission, right? Or the same thing, with Munger, or is either Munger or Buffett, don't ask a barber if you need a haircut. Of course, that's the business they're in. So anyway, so here's Jesse Felder, a tweet from him, somebody else I follow on X. So you see, this is the S&P in orange, and then you see the consensus bullish sentiment. It's at record highs, as we pointed out. Consensus bulls now match their highest level in 20 years. Now, that doesn't mean things can't go higher. They very well could go higher for some period of time, but at some point, things just get too expensive. This is what I was talking about. I don't even know anything about this company. It's Super Microcomputer Inc. I don't know. Anyways, this thing basically in 2024 basically went from like between $200 and $300 a share, going up and kissing 1,000. Now, there's people that rode this. I know nothing about this company. I know nothing about this stock. I don't know if this is a good company, bad company. I just think that, what I wanted to point out here is this daily RSI. It hit a record-breaking 97 as stock rises above $1,000 a share. What I didn't show is the next day, this thing is already, there's a big, I think it dropped like 15%. So any kind of stock that, or any kind of asset class that moves like this in a short period of time, inevitably it doesn't just keep going up. It doesn't consolidate in many cases and move higher. This thing's up 5 times since the start of the year. And so this is the problem, right? This stuff gets highlighted, this stuff gets on the message boards, and I don't even know. I don't even go there. I don't want to know. I don't like looking at that stuff, listening to people that don't really know what they're talking about. But God bless you. I mean, there's people that bought calls down here and wrote them and made a ton of money. Now, but the problem is, can they do that consistently? Can they do it consistently? You can go to a casino and play a slot machine and win a jackpot, but if you keep playing, gambling, because that's what this is just momentum. This is just buying what's going up, chasing shiny objects. You're not going to be successful. And so, again, this is like record amount of over bullishness as relative strength. I think there was one other stock that was mentioned in the tweet where I got this chart. It was like GameStop, and it's like when it hit something similar to this high the next day, it started going down. So anyway, this is what you see in bubblicious markets. Okay. But again, if this is the game you want to play, then at least know what you're getting into, that you're just basically gambling. So this was another chart. So valuation does matter for forward returns. So let me explain these a little bit. These are dot plots, basically, or dot charts. So on the side here, you have the price versus 10-year average earnings, PE 10. So PE ratio basically over 10-year averaged. And then you have the forward price change, 10-year price change. So you can see that the lower the PE 10 price versus 10-year average, this is emerging markets and developed markets, you can see, the better your returns. So if you're buying overvaluation up here, your returns have a tendency, to be negative. So here's 0. And so the higher your starting point of your PE ratios, I mean, we've talked about this before, and it's the same thing in the developed markets. If you buy overvaluation, your returns are going to be negative. Conversely, if you buy things that are cheap, just don't buy cheap for the sake of buying cheap, but you're buying things that are the market doesn't value, or in particular, like emerging markets. That's one of the things I'm quite bullish on. I mean, a lot of these markets are ignored. Everybody's in the US and nobody wants them. It doesn't mean there's not companies there earning money and doing well. They're just undervalued. So that's this goes without saying. I don't know how far back this data goes. This is from Top Down Charts. It's on Twitter also. Guy puts out charts regularly that are interesting. And this goes back to what I've shown before. This is CAPE ratios type stuff. This is Shiller PE ratios. All this research has been done. And again, it's not as entertaining or flashy or what have you to buy something like this and have it go up 5x in a month. That's what people want, right? But I mean, can you consistently find that? Can you consistently find these and buy them and then get out in time? Or is it better just to look for undervaluation, which has we have the data here showing if you buy things that are undervalued and hold them till they become less undervalued, you make money over the long term. You can outperform the market. So I'll stick with the latter. All right. So John Quake's tweet here is pretty good. Has anyone heard of a uranium mining operation that was actually able to hit its 2023 production targets, or that expects to exceed their 2024 guidance? Asking for a friend who sees daily nonstop news of nuclear fuel demand soaring to record highs. I mean, there's nothing new here. We've seen, I don't even look at the uranium Twitter stuff anymore because, again, it's just a lot of mental, excuse my terminology, masturbation. You know, I've been in this since 2017 and I haven't made any money. I'm selling. How is it possible, unless you were churning and trading, to not have bought? All you had to do was buy physical uranium in Cameco and you would have made money. I don't understand how people have not made money. This is the problem, as I pointed out with the CMG fund that during the bull market back in the 90s, run by Ken Heber, I think his name was. They did the research for them and the Magellan Fund. These were funds that dramatically outperformed the market. Okay. And yes, it was the middle of a bull market, and all that. But the research shows that the average retail investor that invested in the Magellan Fund and the CMG Fund lost money because people try to trade. People try to outsmart the market. Okay. It's very simple. Why do you own uranium stocks? What uranium stocks do you buy? A lot of people go and buy the juniors that have no sales, they have no earnings. Okay. And they buy them when everybody else is buying them at the top. Okay. Then when things don't happen the way they want them to happen, they sell them. Then they go on Twitter and say, oh, this is horrible. I just don't know how it's possible that you could have lost money if you were a buy and hold person. They didn't buy and hold. They didn't have the thesis, didn't have the conviction, didn't do the work. A shiny object came by them and, they chased it. And then when it didn't do what they thought it should do for them personally, they got out. And so this is it. This is the thesis. Okay. The bull, I don't know, that's why I don't really talk about it that much. I don't have to do the analysis. It's the general theme. There's more demand than there is supply, and the ability to increase the supply is going to be very, very difficult. Consequently, the price is going to go up until it attracts a ton of capital. And you see, if you listen to the reporting, and I see this already in the US in many industries are complaining the same thing. Oil industry, um, trying to build these chip plants in Arizona and get them up and running. We have financialized our economy and told everybody they need to go get a university degree, a degree in communications or some other dumb degree. Nobody knows how to do high pressure welding. No one knows how to, do any of this stuff. Okay. Uh, you know, be an electronics technician or what have you, or work in these mines or be a geologist or be a petroleum geologist, because there was no money in it. It's dirty. It's awful. It's not the future. Okay. It's not sexy. And so we don't have the people, we don't have the capital, and we don't have the know-how. But that will return. It just takes a long time. And that's why this bull markets and these resources are going to be so, I believe, very lucrative because they're going to be supply constrained. Again, the previous, what I consider resource market that, was in the aughts was a consequence of China entering the WHO and basically going nuts, building everything like they did and just sucking in all of the resources. Now, what we're seeing now is a situation, yes, we're seeing growth in a lot of these emerging markets and frontier markets, but we just don't, because of the underinvestment and the lack of resources and capital, both monetarily or financial and human capital, it's going to be difficult to ramp this up. And that's where your opportunity is. But if you're trading in and out of these things, you're not going to make money. They've done the research. Okay. You have to go look in the mirror and, do you have the patience? And patience comes from research and understanding the thesis. Have you written it down? Do you understand why you own XYZ uranium company? Well, I own it because they have this prospect in, outer Mongolia, and, they're going to, well, are they generating cash? And so, again, you're buying parts of businesses. And so are the businesses creating cash? Are the businesses have a prospect of creating cash? Because if they're not having cash, okay, if they're not generating revenue, if they're not actually engaged in a business, then it's a speculation. And that's a whole different, I've explained this many, many times, but yet we still have folks that, they're going to learn the hard way. We have this constant amount of people coming in to these markets and, they go on and say stuff like, I've been in this since 2017 and I haven't made any money. I don't know how that's possible. Well, I do know. But you don't want to beat up on people. I mean, you go through that as an investor. Every investor, I think, has to go through the learning curve. It's just how fast are on the uptake. You know, do you want to learn the hard way or the easy way? And like I said before, I think the best way to learn is, if I give advice to younger folks, is learn from other folks that have made the mistakes. Why do you need to make the same mistakes? So, a lot of this is around psychology. I've talked about it before, and the ability to control your emotions. And that's like a skill set, like hitting curveballs and being able to run fast. Not everybody has it, I don't think. And I think that's why you can read a lot of books, but really training yourself and being able to, it's kind of like, what's your mental framework and how are you set up, as a person. Everybody's different, right? Everybody can't take the same amount of grief, you know. So anyway, I think it's interesting. But this is basically it. I mean, until I see announcements of these major mines coming on and them actually coming online and boosting production, we're not seeing it. We don't see any prospects of. We just have a lot of talk right now, and we'll see. It's the same thing, on the demand side. What do we see? We see the world has shifted from several years ago, just several years ago, 2 or 3 years ago. Nuclear was out. It wasn't going to come back. It was harmful. Blah blah blah. Now everybody realizes it's going to be the panacea. Okay, and so the demand is fixed. It's going to move higher, and supply. Believe me, if the price gets high enough capital will come in, but it'll just take time. Okay, and again, that's what I think your opportunity is. You have to really. I'm not saying you go all in on this, but you got to have a position, right? So this is what I wanted to point out. Here's another tweet from John Quakes. I broke it up into side by side. It says nuclear utility demand exceeds 1.25 billion pounds needing to be contracted by 2035. That's only 11 years, guys. That's about how long it takes to build a mine if you start now, right? Consultants UXC estimates supply gap of 54 million pounds in 24-25 and cumulative shortfall of 402 million pounds through 2033. WNA strongly warns not all utilities will get required fuel. So this is just another snippet from another analyst. It says uncommitted nuclear utility demand exceeds 1.25 billion pounds of U3O8. As WNA strongly warned, not all utilities requiring uranium will receive the fuel it requires. I've said that before. That's the musical chairs I've talked about. UXC says that demand exceeds supply by almost 1 billion pounds by 2040. And uncommitted demand is even higher, with 1.25 billion pounds of contracting needed by 2035. In the short term, WNA's estimate of 2023 uranium requirements totaling 171 million pounds versus 128 million pounds of production last year. Red Cloud estimates 175 million pounds of U3O8 demand and 135 million pounds of supply. UXC numbers appear even higher, with forecast demand of 198 million pounds versus only 162 million pounds. That left a 36 million pound gap that is growing, estimated at 54 million pounds in 24-25, and a cumulative shortfall of 402 million pounds through 2033. And so the thing that fixes this is higher prices. Is it going to be a direct linear growth in the price? No, you're going to have ups and downs, which we've seen. It's going to be volatile. And if you don't have a position, wait for a pullback and buy. You buy on dips. That's what you do. There's not really much more to say about it until you start seeing massive mines come online or even being talked about being brought online. You just buy and hold. So I wanted to point this out. I have been bullish on energy overall, particularly because of the underinvestment theme, basically, without getting too far into it. I've told the story many times, but wanted to point out this tweet by Jesse Felder. At 30% of the S&P's market cap, only about 20% of the anticipated earnings, The tech sector's weight is now roughly 8 times that of energy, an even wider gap than at the height of the tech bubble 24 years ago. You can see it here. Here's sector weighting for tech and energy. And anecdotally, I think last week pointed out the fact that you could take the market cap of NVIDIA, which exceeds basically all of the market caps of all of the components of energy in the S&P. That's like all the big, multinational oil companies, plus all the other oil companies that are in the S&P. And I think you had money left over. So, you know, where do you want to be? You have Vicky Hollub, the CEO of Occidental Petroleum. I put her comments up last week that she's forecasting a supply issues with oil. In my weekly free email that's going out, I kind of show a recent interview by Adam Rosenzweig of Goring and Rosenzweig talking to Chris Martenson. They talk about this. Basically part of the thesis or part of the view is that the shale, North American shale, basically was the growth in supply over the last 12, 15 years, which kind of masked the rest of the world's underinvestment in new reserves. And so you had this massive amount of production growth, which you don't have to rehash, but we're already seeing, as I've said before, that can't just grow forever, right? At some point, it becomes beyond the geological ability of these basins. Plus, it gets into exponential growth, which isn't possible when you're talking about extractive industries. And so what I thought was good in this, you can sign up for my weekly email, free emails that I have. You can do that in the show notes or in the comments. I think it's the first pinned comment. Give a link to that, but also have some more discussion. When you look at, for example, the amount of per capita oil that people in the developed markets like the US and Europe use in Japan versus even through all of China's development, it still has a lot of potential growth. And then places like India and Africa. So, bottom line is people will say stuff like, well, I heard one person say, well, if the rest of the world, the other 7 billion people in the world got their oil demand to the level of Europe and the US, then we would need approximately like 200 million barrels plus of oil supply per day. We're at about 102, 103 right now. I mean, that's certainly not going to happen, right? So, and especially, you can have periods of short-term periods, 6 months, a year, where you have economics, kind of putting a wet blanket on, the oil price. But as I've said, we're getting into now a synchronized growth or synchronized actions of central banks to start cutting rates. The next liquidity cycle, if you will, we are seeing global demand is going to be increasing, forecasted to increase. Basically, if you look at the historical narrative, it increases by 1 to 1.5% a year. Plus, you have to deal with the depletion. We've talked about this before. And so, again, as in most other resource markets, the underinvestment is going to manifest itself in higher prices. And so there are plenty of companies that are doing well in this current price environment and will do substantially better in a higher priced environment. And I think that higher priced environment's coming. I mean, what's Brent at, $82 or $83 a barrel? And so that's very positive. There's oil companies that are killing it on cash flow. And there's so many companies out there, guys, that have undertaken shareholder friendly policies. Like there's one company I like in Canada. It has long life reserves, low decline. It's had a policy for the last couple of years of paying down its debt, and at certain milestones of debt repayment, they have increased returns to shareholders via dividends and buybacks. And so that's all of the things I like to see as an equity holder, right? Pay down debt, which is accretive to me as an equity holder. I would prefer more buybacks, but that's fine. And this cash flow just getting more and more directed. So there's hasn't been a lot of interest in a lot of these companies by the generalist investors because of this AI stuff that's going on. It's not flashy, but the cash flows are there. The balance sheets have been repaired. And we're probably going to be moving through the end of this decade, at least, into a period where the underinvestment is going to crash into the underinvestment in new reserves and new supply is going to crash into increasing demand and depletion, resulting in, I think, inflation-adjusted new highs in the oil price at some point. So it doesn't have to like go to 150 for you to make money. There's plenty of companies that are generating tremendous returns, and it's like, do you want to buy companies like that are actually sending you checks or buying back shares and increasing the value of your existing share that you're holding, or do you want to buy things that could be very well-run businesses but are tremendously overvalued? It's just what each person wants to do. I look at this and see what happened the last time this happened in 2000 with the tech bubble, and energy was under represented in the S&P, and over time, over a 10-year period, you see what happens. Tech came down and as a percentage of the S&P, and energy went up. I think the same things. I mean, this period of undervaluation we've had, or underrepresentation of energy, which is it's just a tremendous opportunity. This is probably one of the best charts that represents my thesis right here. So we'll see. So Codelco, which is the state-owned copper miner in Chile, logs December production setback. So Chile's top copper miner closed out 2023 unevenly, with state-run copper miner Codelco logging a setback in December, according to figures released on Monday by the Chilean Copper Commission. Codelco saw production fall 8.3% year on year, with its production in December alone dropping 2.1%. So if you read the rest of the article, like BHP and the other private copper miners, publicly traded ones, actually were able to raise their production, but not that much. So net copper production was down. And so it looks like the bloom on the ESG, the EV, the whole, copper was going to just be, all these minerals were going to be needed for this big ESG push. It doesn't look like that's really going to happen now. But there has still been, that was just going to supercharge, which was already an initially bullish environment for these metals, because all of these resources are in the same boat. Chronic underinvestment because of the financialization of these economies. We don't need this stuff, or doing dumb stuff like we do in the U.S., saying we want to have this transition to renewables and what have you, but it requires all these mineral inputs and then banning mining in the various areas in the U.S. So this is all positive long term. And again, I believe that these undersupply issues will be solved, but it will take a tremendous amount of investment to do that, and it's not being made right now. And again, you're going to run into more constraints around, human resources, skill sets, capital, machines. They can all be solved. It just takes time. In the meantime, if demand goes up and you're not able to flex that supply because you've not done any investment in 10 years, you're going to have higher prices. Just another thing on copper. This was an interesting chart I grabbed off Twitter. S&P Global Copper Users PMI, again, Purchasing Managers Index in manufacturing. This is basically just telling you that the countries that are copper users, manufacturing, building houses, this type of stuff, that are big into this, their PMIs are over 50. Now you see how over 50 is expansion in manufacturing. So typically that would require more inputs, right, of energy and resources if your manufacturing PMI is growing. So just something to keep an eye on. I'd probably be interested, maybe I'll do this if I can get the raw data, is try to overlay the copper price on this chart and see if, as this moves into expansion manufacturing around the world, the copper price follows. There's a lot of factors that go into these minerals. This is just kind of a general statement that, playing off that whole Dr. Copper, it's very good at, economic forecasting. But think about this, guys. For the period that the economies around the world have been weak and so many economies are in recession and what have you, we're coming out of that now, as again, because of all the rate cuts and, new liquidity cycle. But copper really didn't like collapse, either did oil. And, again, maybe we're out of sync with the rest of the world as it starts emerging. You can find all this data online for free. You can look at each country, each region around the world to see where they are in their expansions and stuff. We're not in a synchronized expansion. Again, what has happened is that a lot of the countries, most of which were in the emerging markets, that were the first to raise rates, are now in their rate cutting cycles. And the developed world was later to the rate raising cycle, and now is at their pauses and will eventually on the back end be, they're lagging behind what we're seeing in the rest of the world. So again, I expect copper demand to go up over time, regardless of what happens with, ESG. That was more cake than, meat. So, but this is again something to pay attention to. I wanted to point this out. I find it interesting because it kind of goes back to, I run across this stuff in my in my readings and looking for data for the weekly report. And this is a chart that shows national oil company strategic positioning. Basically, somebody went and did this analysis. Basically, it's showing national oil companies' operational capability against its operational autonomy. And so when you have state-run oil companies, you're always wondering, well, how much autonomy do those people have? Are they political appointees? Yada, yada, yada. So you see on operational capability and operational autonomy, here's, the Venezuelan state-owned oil company, which is a disaster. You see various other ones. There's Gazprom in here, Rosneft, Saudi Aramco is kind of in the middle here. So they have very high capability, but what's their autonomy? A lot of these obviously are run for the benefit of the state, and trying to extract these resources and use them for political patronage, military, what have you. I find it interesting, though, if you go over here and look at autonomy, 3 of the companies that have the most autonomy and their capabilities are fairly good also is the state company Petrobras, which does have a component of it does trade publicly, Ecopetrol, which is the Colombian national oil company, and YPF, which is in Argentina. So I thought this was an interesting analysis. I don't know who did this analysis. I don't know really what went into it, but when you do look at knowing that the Venezuelan national oil company is kind of a disaster, and then look over here at the rest of these South American companies, you see that yes, they may have state-owned. This is part of when I get to sentiment, this just assumption that everything gets lumped in because Latin America is a bunch of socialists and blah blah blah, and if you buy any assets there, they're going to confiscate them. That's not true in all cases. So I think there's opportunity there. What I'm getting at is in the newsletter, I'm moving more and more into Latin America and Mexico. I'm just seeing a lot of positive catalysts there. And I'm seeing a lot of central banks cutting rates there. They were very good on raising rates. They had positive real rates there for the last couple years coming out of COVID. They really clamped down on their inflation, and they were really able to, so you say, well, what about the elections in Brazil? You saw who came to power. Well, if you look at the Brazilian stock market, the last time Luna was in power, I mean, it boomed. So I said the same thing to somebody else. I mean, you had a situation where President Obama was in power. I didn't necessarily agree with his policies, but the stock market boomed while, after he got elected. Why? Because the Federal Reserve was cutting rates after the Great Recession. Again, liquidity has a tendency to do that when you increase liquidity by cutting rates. So you're seeing something similar in Colombia. There's a guy there that was going to do all this big socialist, but it's a pretty fairly mature democracy there, and so he didn't have the votes in the parliament, and so he wasn't able to do these are not dictatorships necessarily. So there's just like here. I mean, these things, people could say what they want, and a lot of times people get elected just because it's a protest vote, but what are they really able to do? You're seeing the same thing now in Argentina, all the fanfare around Milei, but then he kind of, in my opinion, made a mistake and tried to package up all his reforms in this grand bill, and it got rejected. So now that's kind of shows the immaturity. You're dealing with a lot of vested interests, and you have to pick what battles you can win and where you can build up coalitions. And a lot of these people are not really skilled politically, or don't have, so if you just read a headline and say, well, Luna's a socialist, or you just make a general comment like that, you don't really know what's going on with these companies or underlying factors. I think you could miss out on a lot of potential returns. Again, I'm uh, very, very positive on Latin America and Mexico, or I should say South America and Mexico. They're all Latin America. All right, guys, that's it for this week. We'll talk to you next week. Thanks.